Imagine you just signed a 2-year power contract. You've spent $5 million on mining machines. Your electricity bill is fixed. Your loan payments are fixed. You know exactly what it costs to run your operation every single month. Now imagine your revenue isn't quite as locked in. You have a rough idea, but it isn't totally clear. That's what it's like to be a Bitcoin miner. This is part of our Hashrate Markets Explained series, where we're breaking down how hash rate derivatives work from scratch. If you haven't seen the earlier video, you should be fine here. But if anything feels unfamiliar, check the playlist and start from the beginning. In the first video of this series, we established that hash rate is a commodity, just like oil, just like corn. Miners produce it, the network consumes it, and there's a market price for it called Hashprice. And like every other commodity producer on Earth, miners face a fundamental challenge. The price of what they produce changes constantly. Hash price is driven by 4 independent variables, all moving at the same time: Bitcoin price, network difficulty, block subsidy, and transaction fees. The result is that hash price can swing $5 to $7 per petahash in a single month. For a miner running 100 petahash, a $5 move translates to about $15,000 in monthly revenue gone or gained. Hash price runs roughly 20% monthly volatility. That's higher than crude oil and about 5 times more volatile than the stock market. And unlike a stock portfolio, a miner can't just close a position and walk away. The machines are running, the power bill is coming. Every other cost in a mining operation is relatively predictable. Electricity, hosting, labor, loan payments. Revenue is the wild card. And that mismatch between fixed costs and unpredictable revenue is the fundamental problem of Bitcoin mining. This problem isn't new. In fact, it was solved over 170 years ago by a corn farmer in Chicago. In the 1850s, a farmer would spend months growing his crop, but he had no idea what corn would be worth when the harvest came. One bad week in the grain market could wipe out his entire season's work. So he made a deal. Before the harvest, he agreed to sell his corn at a fixed price to a buyer. If the market dropped by harvest time, he was protected. If it went up, he'd miss some of the upside, but his farm survived. He could plan, he could borrow, he could sleep at night. That agreement was one of the world's first contracts, and the exact same structure now exists for Bitcoin miners. Instead of selling corn at a fixed price before a harvest, a miner can sell their hash rate at a fixed hash price before it's produced. Same problem, same solution, 170 years apart. Now you might be thinking, can't miners already hedge using Bitcoin futures? They can sell Bitcoin on CME or some other exchange. But that only solves part of the problem. Bitcoin futures only hedge one of 4 variables that drive hash price: Bitcoin price. They don't protect against difficulty increases, transaction fee collapses, or the halving. Here's a scenario that trips people up. Imagine Bitcoin price stays perfectly flat for 3 months, but difficulty increases 15% because a wave of new machines came online. A miner who hedged with Bitcoin futures, their hedge didn't trigger because Bitcoin price didn't move. But the revenue dropped anyway because hash price dropped. That's the gap hash rate derivatives fills. When you sell hash rate forward at a fixed hash price, you're hedging the all-in revenue per hash, all 4 variables at once, not just Bitcoin price. This is why a growing number of miners, lenders, and investors are focused specifically on hash price rather than just Bitcoin price. It captures the full picture of what mining revenue actually looks like. There's one more reason miners hedge that most people don't think about, and it has nothing to do with predicting the market. It's about how much it costs to borrow money. If you're a lender and a miner comes to you asking for a loan, the first thing you want to know is how predictable the revenue is. A miner with unpredictable revenue is a riskier bet. That means higher interest rates, tighter covenants, or the lender just says no. But a miner who is locked in their revenue for the next 6 months, that's a much simpler credit decision. They can show the lender exactly what their cash flow will be. Lower risk can mean better financing terms. Better terms means the miner can grow faster, buy more machines, or compound their operation. Traditionally, miners have been stuck in a trade-off. You can raise equity, but that dilutes your shareholders. You can take out a loan backed by your Bitcoin or your ASICs, but lenders require you to over-collateralize, which ties up capital you could be deploying. Both options are expensive, but neither is built for how mining actually works. Hashrate-backed financing changes that equation. It's non-dilutive, it's capital efficient, and hedging your revenue is what makes it possible. So hedging isn't just insurance. It's what unlocks a better way to fund your business. Let's recap. Mining revenue is wildly volatile. Fixed costs, unpredictable income. That problem was solved in commodity markets over a century ago with forward contracts, and the same solution now exists for hash rate. Bitcoin futures only cover one of 4 hash price variables. Hash rate derivatives covers all 4, and hedging isn't just about protection. It can lower your cost of capital and make your business more fundable. Now you understand why these tools exist. In the next video, we're going to get into exactly how they work, what a forward contract looks like, how settlement happens, what USD versus BTC contracts mean, and how to read the forward curve. Make sure you're subscribed so you don't miss it. See you in the next one.